Okay, I think I'll start the session. It's 6 o'clock. Yeah. So good evening, everyone. I'm Professor Mansi Gokhale, and I'll be conducting this live session for the course Accounting for Managers and on modules 1 to 6. So basically what we are going to, a few things before we start the session. I will run you through the PPT, which will give you an overview of what are the significant or important or relevant topics or subtopics in module 1 to 6, okay, which are a very essential part of this course. That is the first thing. Second thing, whatever are your questions, I would like to take those questions at the end of the session, okay, and not during the session. So first, let me complete or deliver what I'm supposed to and what I want to, and then you can ask me the questions in last 10 to 15 minutes. Okay, so please mute yourselves, don't unmute in between because that causes a lot of disturbance when the live session is on. So now module 1 to 6 basically is to give you an overview of the accounting process. So it starts with what is accounting, why it is essential, why should PGDM students or management students should learn this subject, what is its relevance, how it is useful, then how accounting is done, right? So what is the process of accounting? And module 1 to 6 also covers like a topic or a chapter on financial statements for sole proprietary concern. So if it is a sole proprietary concern, a single person doing business, then what are the financial statements that he is required to prepare? So first we will start with the basics of what is accounting. Okay. So please put off your video and please mute yourselves. Don't put yourselves on, don't unmute yourselves at any point of time during the session. So let us start with the basic question of what is accounting, right? So in simple layman's terms, so that we all can understand, Ashna, if that person puts on his video again, please just message him and ask him not to put on the video because it is very distracting otherwise. Yeah. So when we look at what is accounting, so in layman's term or in simple terms, accounting is recording the financial transactions of the business, right? It is recording of financial transactions of the business. Then it also, the term or the meaning of the term accounting also includes how the financial transactions are to be recorded, in what way they are to be recorded, right? So it is recording of financial transactions of the business in a systematic manner. Okay, so there are some certain rules that are to be followed when you are recording the financial transactions of the business. So it involves recording, some classifying the transactions. Again, recording is one part, classifying the transactions of the business according to their nature is another part. The third part is summarizing the transactions. Summarizing means you are finalizing your books of accounts, you are preparing your financial statements, right? So accounting involves three parts: recording, classifying, and summarizing the financial transactions of a business in a systematic manner, following the accounting standards and accounting rules. So there are certain set of rules, there are certain set of accounting standards which govern how a particular financial transaction should be measured, at what amounts it should be recorded, how it should be recorded, how it should be presented. So accounting is all that. Now, if you look at it in a different point of view, or if you look at it as an information system, since you are management students, right? So like keeping aside the traditional definition that recording, classifying, summarizing the financial transactions, following the accounting standards and accounting principles, if you keep it aside and if you look at it as an information system, okay, so what does an information system do? It takes a data, raw data, it processes that data and it gives you a meaningful information out of that data. So in the same way, you can look at accounting as an information system. Okay, why is accounting an information system, or why do we say, why do we call it an information system? Because it provides important information about the financial transactions of the business, which is useful for decision making by various stakeholders who are in some or the other way associated with the business. So you can look at accounting as an information system. The data that goes into this information system is the financial transactions. This data is processed, the rules are applied, the accounting standards are applied, and the end result or the output is your financial statements. Okay, you know the financial statements are profit and loss account, which will tell you about the financial performance of the business. You have balance sheet, which will tell you about the financial position of the business. Additionally, cash flow statements are also prepared, right? So look at accounting as an information system. It is converting the data into information which is useful, which is relevant for taking decisions relating to business. Okay, that is the second way in which you can explain the term accounting. There is one more way in which you can in one sentence you can explain the term accounting, and that is accounting is a language of business. Right? What is the purpose of language? Now, when I'm speaking to you in English, right? English is a language, right? So what is the purpose? The most basic primary use of language is communication, right? So in the same way, accounting communicates information about the business, right? So what is accounting? Firstly, the traditional definition, it is recording of transactions, it is summarizing them, classifying them, applying the rules, and preparing the financial statements. That is the first definition. Second is it is an information system because it converts the raw financial data into meaningful and relevant information in form of financial statements. And last but not the least, you can say that it is a language of the business, right? So this is what we discussed right now. Accounting. Look at accounting as an information system. As management students, look at it as a language of the business. Okay. So as an information system, input is in form of source documents, the financial data, right, for the business. Processing is done using the accounting standards and principles. Processing of this financial data is done, right, when you actually record, classify, summarize, okay, and the output is your financial statements, the profit and loss account, the balance sheet, and the cash flow statement, right? So this is what I discussed. Now, what are the objectives of financial accounting? Or what are the functions? What does accounting actually mean? Or what is done when you say I am writing the books of accounts for a particular business? What is actually done? So first is recording of transactions is done. Financial transactions are recorded in the books of the business. So first step is recording, which is also known as journalizing. Yeah. So in primary books, the recording of transactions is done. Then the transactions are classified according to their nature, according to the accounts involved. So you post the transaction into the ledger, right? Then summarizing is done. A trial balance is prepared. Based on that, financial statements are prepared. Now, these financial statements will help us to assess the financial performance of the business and the financial position of the business. Now, what is the use of these financial statements? If strictly they're used internally by the management and the owners of the business, then they become an important document for future planning, for controlling also. So if particular expense was more than that was budgeted for, so yeah, it acts as it helps in controlling. It helps to understand where expenses have exceeded the budget, where they have been incurred within the budget, right? It helps for planning for future also, right? So these are basically the functions of accounting. Yeah, can we have polling question 1? Yes. Is it visible to everyone? The poll is visible to everyone? Okay. So one of the following is not the characteristics of accounting information. So read the question carefully. I will discuss the question also once the poll is done. Read it carefully before giving your answers. What is asked is what is not the characteristic of accounting information. Those who have still not answered the poll, please quickly answer it. Still, I guess few students have not yet answered it. Yes, can we end the poll now so that I can discuss the... Okay, so a simple question was asked. Okay, one of the following is not the characteristic of accounting information. Okay, so relevance. Okay, here that, okay. I think here it should be only relevance, that future transactions has come by mistake here in option 3. So understandability, yes. So when you look at accounting information, you will understand about the financial results of the business. So that should definitely is a characteristic of accounting information. Completeness, it gives you a complete picture, right? For the past, say for example, for a particular year or for a particular month, okay, the profit and loss account, balance sheet is prepared or ledgers are prepared. So it gives you complete information about the financial transactions of the business. So that is also a characteristic of accounting information. Relevance is definitely the information, that is, the accounting information is definitely relevant in the sense that it is useful when I say relevant. Okay, but future transactions, this is definitely not a characteristic of accounting information. We do not we do not come to know about how the transactions will be in the future, but of course it can be used for making some projections or estimates. If this year the revenue was, to the tune of say so and so lakhs, so considering the business conditions, it is possible, or considering the expansion plans or investment in assets, it is possible that the revenue can grow by, so a informed estimate can be made. But definitely accounting gives you the historical data, or it tells you about the historical performance in past, or it gives you, it is a form of a feedback measure, right? So in the last 1 year, what is the profit or loss that the business has made? How is the financial position of the business? What are its liabilities? What are its assets? So future transactions are, you cannot know future transactions from the accounting data. It is based on the historical information or the historical data, right? So future transactions is the correct answer. Future transaction is not a characteristic of accounting information. Understandability, completeness, relevance, all these are important characteristics of accounting information. Right. Now, just as we said, like, what is accounting? Then why is accounting essential? Why is accounting essential? Because it provides relevant information to the various stakeholders associated with the business, right? So it provides information. Based on the information that is provided by the financial statements, the stakeholders can take important decisions. Okay, management can, like, management will look at the data. Okay, they will look at it quarter wise also, at times half yearly, quarter wise, month wise, to see that whatever targets they have set in terms of revenue, in terms of profits, are achieved or not, right? Owners will look at it to see whatever is the goals, long-term goals they have set, whether business is going in that direction. Okay, investors would want to decide on whether they should continue holding their investment, or they should sell off, or they should buy more stake in the business. Lenders would look at the financial stability, because they are interested, they want to know that whether their principal and interest will be paid on time by the business, right? Similarly, suppliers and customers, they are also important stakeholders, right? Suppliers business would depend upon the business, uh, the person who is supplying some material to the, say for example, business X. So he would be very much interested that that business X does well, because then it is a source of revenue for the suppliers. Customers would be interested to know whether they would get good quality of uh, product and services from the business. So they, therefore they are interested to know whether business is doing well or not. Government, of course, tax is an important source of revenue which is paid by the businesses. So they would want to know whether that tax is correct, properly calculated on the profits and paid to the government, right? Employees, of course, they would be interested because they get their source of income from the business, so they would want to know what are their future prospects. Is there prospects for future career growth? If business is doing well financially, then their salaries would be good in future, right? Also, they would be interested to know if they, they are going to continue with the same organization on long term basis, then they will be able to get good retirement benefits, right? So all these stakeholders are interested in the general public and society because there are social costs associated with business. So they would want to know if the business is overcharging the customers, okay, or if it is incurring social cost in terms of harming the environment. How are its CSR activities? How is it giving back to the society? So all this information the business the stakeholders will understand from the financial statements. Therefore, accounting is very, very essential because it provides you with the report card of how that particular business or organization has done financially, right? Okay. And this report card is useful for all the stakeholders who are associated with the business. Why it is useful? Because it helps them in taking relevant decisions. Useful. So accounting information is definitely decision useful, right? So once you complete your PGDM, few of you must be already working. I'm very sure of that, right? So all these numbers. So if you're projecting for future, also you need some basis for that, and the accounting information, the historical data will be used as a base. Of course, you will make some adjustments to that data when you're projecting your future revenues or revenues for the next quarter, for example, or expenses for the next quarter. But still, the base will be the historical data. From where are you getting this historical data? Accounting is helping you to churn it out, right? So these are the users of accounting information. Okay. Now coming to accounting concepts and conventions. Now we said that accounting is a language of business. Now, if I want to communicate in that language very properly or effectively, right? Then first and foremost thing is that I should learn the grammar of that language. Okay, without grammar, communication, effective communication, or even communication will not be possible. So if that language has to be mastered, then the grammar also is equally important, or it is a prerequisite. In the same way, if accounting is the language of business, then accounting concepts, conventions, accounting principles are the grammar. Okay, accounting principles are broad guidelines. They will tell you how a particular business transaction has to be measured, at what amounts it should be recorded, when it should be recorded, right? How it should be presented in your books of accounts, how it should be disclosed. That is your accounting principles. Now, accounting standards, they are based on the accounting principles, right? But they have a legal backing. They are formal rules which are formulated by the local accounting bodies. Okay, so they are binding on the business organizations, right? So for example, the Ministry of Corporate Affairs will notify what are the accounting standards which are mandatory for company form of business organization. Okay, so accounting standards are formulated based on the accounting principles, but accounting standards have a legal backing. They're formal rules. Okay, and they are formulated by the local accounting bodies. So here in India, the accounting standards are formulated by Accounting Standard Board, which is constituted by Institute of Chartered Accountants of India. This accounting standard board has representatives from government, from industry, from accounting fraternity, right? Okay, and they formulate the accounting standards. Now, what are accounting policies? Accounting policies, each business organization will see the accounting standards, and then based on that accounting standards, they will formulate their own accounting policy. Okay, for example, there is a matching concept which is accounting principle. Based on that matching concept principle, you have an accounting standard for assets. That accounting standard will prescribe different ways in which depreciation can be calculated, right? So a particular business will formulate its own accounting policy stating that, okay, as per this accounting standard, these two methods of depreciation are suggested, and we are going to follow method number 1 because that is most suitable for our business. Okay, so accounting principles, broad guidelines, universal broad guidelines. Accounting standards will be country specific. Each country will have their own local accounting bodies formulating their accounting standards. Accounting policies are company specific. So based on the accounting standards, whatever is the requirement of the business, whatever is suitable for their business, each company or each business will have its own accounting. Now let us see what are different accounting principles or accounting concepts. So this is a grammar, right? Based on all these concepts, your accounting rules or accounting standards are formulated. Okay, so we will quickly look at each of this concept, right? Briefly, I will explain. Whatever are resources shared through Canvas, this is already explained in detail. If you have gone through it, and I don't know whether you have started studying through it, but these are explained in detail. Here, I will just tell you the crux of each of this accounting concept before we move on. Okay, so business entity or separate entity concept. Now, what does this concept state? This concept states that the businessman and the business are two separate entities. Okay, so from point of view of accounting, you have to treat the businessman and business as two separate entities. And what should be recorded in the which financial transactions should be recorded in the business books? Only the financial transactions relating to the business should be recorded in the books of business. Therefore, if I am a sole proprietor, I am having my own business. So whatever capital I have contributed for running the business is treated as a liability for my proprietary concern. For me personally, in my books, in my personal books, I will show it as an investment. And in my business books, I will show it as a liability or a capital. So what does business entity concept states? Business entity concept states that from point of view of accounting, businessman and business are two different entities. Okay, what should be recorded in your business books? Only your financial transactions related to business should be recorded, right? Then money measurement concept. Money measurement concept says that only those transactions which can be quantified in terms of money should be recorded in your books of business. There could be certain events which could have financial implications for the business, but if you are not able to quantify them, if you are not able to put any monetary value on them, you cannot record those events or transactions in your business books. For example, my production manager and my marketing manager, they do not get along well. So whatever sales or business the marketing person brings in, the production manager makes sure that it is not completed, the orders are not completed on time. This has an impact in the sense that I lose out on customers, right? So this is having financial implications for my business, but I'm not able to quantify this tiff between the two, or the not getting along of production manager and marketing manager. I cannot quantify it exactly in monetary terms. So I cannot record the implication of this in my business books. Another example is a very senior person who is expert and who is helping me to generate good revenue leaves my business. So naturally, if he leaves my business to join some other organization, it is definitely going to cause me some loss, or there could be some what you can say interruptions or loss that I may have to suffer because that person is leaving. Okay, this event is going to have financial implications, but I cannot quantify or exactly measure the loss, and hence I will not be able to record this event in my business books. Okay, so money measurement concept says that only only those transactions which can be quantified in terms of money should be entered or should be recorded in the business books. The third accounting principle or concept is going concern, which is also your basic accounting assumption. Going concern states that how should the financial transactions be recorded? They should be recorded assuming that business will go on for an indefinite period of time. Okay, you have to assume that I have started the business in order to continue doing it for an indefinite period of time, in foreseeable future, till I will be continuing the business. And that should be the basic assumption whenever I'm recording the business transactions. If it is a seasonal venture, or if I know that I'm going to, I've entered into this business only to be there for 6 months, then a different principle or different set of rules are applied when you're recording transactions. And I will specifically mention it that business is not a going concern, right? Okay. Or the business is a seasonal venture and it will be shut down, or the joint venture is a temporary one, or the venture is temporary one and it will be shut down in few months or whatever. Now this going concern assumption, assuming that business will continue in foreseeable future, necessitates the next accounting concept or principle, that is accounting period concept. Now if business is a going concern, you cannot wait for infinite period of time to understand the financial performance of the business, right? So that infinite period of time is broken into definite period of 12 months to understand the financial performance of the business. How has the business done? So accounting period concept says that the financial transactions and the financial statements should be prepared for a period of 12 months to understand the financial performance, to understand the financial position of the business. So this is your accounting period concept. Now, a very important concept, many a times those from non-accounting background get confused with this, okay, is the accrual concept. What does accrual concept say? You have to record the incomes when they are earned for the business, and you have to record the expenses when they are incurred. So in plain and simple language, it says that not only cash transactions, but also credit transactions should be recorded in your books of accounts. Okay, so income earned and expenses accrued, expenses incurred should be taken into consideration. When is income earned? Income is earned when you get right to receive it. When do you get right to receive it? When the goods or services and the risk and rewards associated with those goods and services are transferred to the customer. So usually they are transferred to the customer through delivery, right? So whenever the product is delivered to the customer, right, and the risk and benefits that are associated with that products are also passed on to him. He can do whatever he wants with the product. He can consume it, sell it, destroy it, whatever, right? So then we can say that the risk and rewards associated with the product are transferred to him. So if any loss is incurred, if some it is lost due to fire or it is damaged, then it is the responsibility of that customer. Then we can say that the business has got the right to receive the money. Okay, so at that time, I should record the income, and expenses should be recorded when they are incurred. When are the expenses incurred? When the business has consumed benefit, right? So for example, if I'm consuming electricity for a month, right, then that expense on account of electricity is incurred by the business. Why? Because I have consumed the benefit. So now it is an obligation on me to pay the electricity bill, right? Okay, so this is what the accrual concept states. How should you recognize, or when you should recognize the transactions? Income should be recognized when it is earned, and expenses when they are incurred. So you should record both cash transactions also as well as credit transactions while recording the business transactions. Okay. Now the next accounting concept is matching concept. What does matching concept state? Matching concept states that while ascertaining the profit or loss, okay, the costs incurred to earn the revenue should be matched against the revenue, okay, to find out the profit or loss. Okay, that is a matching concept. So for example, I will give you an example and you have to put your answers in the chat box. Okay, so for example, I purchased goods, say 1000 units. Pay attention carefully. I purchased goods 1000 units of certain goods at the rate of ₹10 per unit. Okay, I purchased goods 1000 at the rate of 10 per unit. Okay, I sold out of this 1000 goods that were purchased, I sold 800 units of goods at the rate of 11 rupees, at the rate of 11 rupees. So following the matching concept, tell me what is the profit or loss. Put the profit or loss amount in the chat box. Got it? I purchased 1000 units at the rate of 10. I sold 800 units out of that 1000 units that were purchased at the rate of 11. Put profit or loss as per the matching concept on the sale of this 800 units. Okay, what is the profit or loss? Purchase is 1000 units at 10. So total cost of purchase is 10,000 and I sold goods 800 units at 11. So 800 into 11 means 8,800 is the sell and 10,000 is the purchase. So you put in the chat box the amount of profit or loss. Come on, your time starts now. Whether there is profit or loss and what is that amount of profit or loss. Okay, so there are 100 participants and only 6 answers will not do. Okay, okay, okay. Yes, I want more answers. Okay. Okay, so it's between 800 profit or 1200 loss. Okay, somebody has written some profit of 800. Okay, okay, okay. Yes, few more answers and then I will discuss this. Okay. 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 So many of you are typing 800 as profit and many of you are saying 1200 as loss. Okay. Now let me see if I'm able to open a Excel. Just give me 1 minute so that I will explain you in that. Just give me 1 minute to open an Excel sheet. Just tell me if that once the Excel opens, just tell me if you're able to see it. Yeah, visible? Can someone just put it in the chat box? The Excel sheet is visible.
Yes, ma'am. It is visible.
Yeah. Okay.
Yes, ma'am.
Yeah. Okay. So now I said 1000 units were purchased at the cost of rupees 10. Right? Okay. Yeah. And out of this 1000, the sale was made was 800 at the rate of 11. So the total cost of purchase was 10,000. Yes. And sales were 8,800. Okay. Now, what does matching concept say? The cost incurred to earn the revenue should be matched against the revenue to find out profit or loss. So what is the cost of this 800 units? So I will put here cost of goods that are sold. What is, how many units are sold out of 1000 that are purchased? 800 units are sold. And what was the cost per unit at which I acquired them? 10 rupees. So here 800 into 10, 8,000 is the cost incurred to earn the revenue. So here 8,800 minus 8,000 cost, I get a profit of 800. Now what happens to this 200 units that I have purchased and they are not yet sold? They will become my inventory or stock of goods remaining unsold. That becomes my asset, right? Okay, stock of goods. This is treated as a asset, the resource that I own, right? This cost will be knocked off against the revenue that will be generated by selling this 200 units, right? So here, as per the matching concept, I have made a profit of 800. Why? Because cost incurred to earn the revenue is 8,000. 800 units sell किए तो 800 units का मुझे cost I have to map it against the sell to find out profit or loss. This balance 200 units cost, it will be mapped against the sale of that 200 units whenever it is made. Till that time, this will be treated as a asset or stock of goods. Yeah, okay, got it. So let's minimize this. Okay. Then let us again start with it. This is visible now, the presentation again. Is the PPT visible now to you or not yet?
Yes, ma'am. Yes.
Okay, okay. So this is about the matching concept. Now coming to cost concept. The cost concept says that the transaction should be recorded in the books at the actual cost that are incurred, right? For example, I buy some goods, I buy it from my friend who gives me a discount, and therefore I am able to buy it at a price which is lower than the market price, right? So those goods should be recorded at the actual cost that are incurred. I buy some machinery on which I get a discount because it is from someone I know or with whom I do the business regularly. Then it should be recorded net of the discount. Okay, so cost concept, it is usually applied when you are recording assets in the books of account. So cost concepts, what is a one line? If you want to explain this concept in one line, cost concept says that record the transactions at the actual costs involved. Okay, now similarly there is realization concept. Realization concept, say it is used to record the revenues, and it tells us when you can consider revenues as realized. Okay, now again with careful attention, I'm giving you an example and you have to put the answer in the chat box. Okay, say in month of April, okay, a customer gives me an order. Okay, he wants some goods from me and he gives me an order in month of April. In month of May, I start working on that order. In month of June, I complete that order. In month of July, I send the goods to the customer. And in month of August, that customer pays me money for the goods that I have delivered. So April, he gives me the order. May, I start working on that order. June, I complete that order. July, I dispatch that order. And August, I get the money. So April, May, June, July, August. In which of the months should I record the revenue generated from this customer order? April, when I get the order. June, when I complete the order. July, when I dispatch the order, or August, when I get the money. So put the answers in the chat box. Okay. Okay, few more answers. Okay. Okay.
Ma'am, repeat the question once.
Okay, again I'll repeat it. When would I recognize this revenue from the order, customer order, whether in month of April when the customer gives the order for the goods to be dispatched, in the month of June when I complete the order, in the month of July when the order is dispatched to the customer, or in the month of August when the customer pays me money against that order. Clear? So when I should recognize it as a sale or revenue? That is what my question is. Okay. 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 So again, I think there is there are equal answers for the month of July when the order is dispatched, and for the month of August when the payment is resumed. So realization concept says that you should recognize revenues in your books of accounts when there is a certainty that you will receive the money, or there is a certainty regarding the receipt of that realization of that revenue. So when will this certainty arise? In April, when the customer gives me the order, I cannot book it as a revenue because I have not yet started also working on that order. It could happen that in May there could be some unforeseen circumstances and lockdown, for example, and I'm not able to complete and deliver the order to my customer. Then how can it be a revenue for me? He has only placed the order, right? And I've just accepted it, but that doesn't give me a right to receive the money, or there is no certainty to receive the that the revenue will be realized at that point of time. Even when the order is complete in June, that I completed order today, tomorrow it gets destroyed by fire or it gets lost by theft, right? Then also there is no certainty of realization of revenue. But in July, when that goods are dispatched to the customer and the customer okays it, saying that, okay, please meet my specifications. Now there is a certainty. Now I have got the right to receive the money. And now I can say that my revenues are realized. With certainty, I can say it. Okay. So I will record the revenue when I send or dispatch the goods to customer in month of July. In August, I just get the money against what was delivered in July. So this is what the realization concept says. Now coming to dual aspect concept or duality concept. Now any financial transaction, okay, has an impact of some asset or liability coming into the business on some asset or liability going out of the business, right? Something comes into the business, something goes out. For example, I purchase goods by paying raw material. I purchase raw material by paying cash. Cash is going out. It is one of the asset. Raw material, again, it is a current asset, stock of raw material. So raw material comes in, cash goes out. If I take a bank loan, so money comes in, I require that source of finance, right? And there is a liability, obligation also arises for the business in the form of bank loan, right? Because I have to repay it. Okay, I repay the bank loan. Money goes out and that obligation also goes out. So any transaction has an effect whereby one asset comes in, another asset goes out. One asset comes in, a liability also arises. One asset goes out, liability also extinguishes. Now this dual aspect or duality concept forms the basis. Mugdha, would it be okay if I answer your question at the last? Or you want to ask it now?
Yeah, it is regarding the realization part.
Okay, tell me.
I just wanted to know what happens if we don't receive the payment in the month of August.
Then you have already sold. It is already a revenue in your books. Then you will record it as a bad debt, a debtor gone bad.
Okay.
Okay, right? Yeah, because your part of contract you have honored, right? Means the goods are delivered.
Right.
So you have got right to receive the money. So you will book that customer as your debtor in your books of accounts. Paisa receivable, right?
Okay.
But tomorrow, if you don't get the money, it will be a bad debt and loss for the business.
Okay, got it.
Okay. Yeah. So this dual aspect or duality concept is the basis for the Okay, am I still muted or you are able to hear me? No, I think.
Yes.
Your voice is visible.
My voice is? You are able to hear me clearly, all of you?
Yes, you are audible. Yes.
Okay, okay. So this dual aspect concept or duality concept, it forms the basis of your double entry system of accounting. For every debit, there is a credit of equal and equal amount, right? Okay, so this debit credit rules are based on this duality concept. Again, this dual aspect concept forms the basis of the accounting equation that we are going to learn or see. Now coming to certain conventions. Now conventions are something which are customarily used. They are widely used trade practices. Okay. So principles and conventions, these terms are used interchangeably, right? But if you strictly bifurcate, then principles are broad guidelines, whereas conventions are which are customarily followed. Okay, widely followed. Now consistency. Now what does this principle of consistency state? Consistency means if you are following, or if you are following a certain method, say for example, for recording depreciation, or if you are recording a transaction, a particular set of transactions in a particular way, you should keep on following the same method and you should not change the method abruptly or randomly, because consistency will help in comparability. If you are comparing the financial results or financial performance year on year, then there has to be consistency, right? Okay, so consistency means the accounting policies, accounting methods should be followed consistently or uniformly year on year, because it will help in um, making the statements or your financials more reliable, right? It will make them comparable. But does it mean that you can never change the accounting methods? No, you can change it if you are able to justify the change. You should also mention in the year of change that you have changed this particular accounting method. What is the reason? What is the effect on profit? All this has to be documented, right? Then conservatism, whenever you are recording financial transactions, you have to be conservative, or you have to follow the principle of prudence. It means that provide for all probable losses, but do not provide for probable gains. Because see, accounting information is going to be used for decision making for different stakeholders. So something which that gain is not yet realized, please don't show high hopes or false hopes to your stakeholders. But if you anticipate that there is going to be loss, a probable loss, you should record it. Okay, so the best example of conservatism is whenever you are recording the closing stock in your books of accounts, right? You will record it at cost or market price, whichever is less. This is because you are following the principle of prudence or conservatism, right? Or you provide for create a provision on profits out of for your bad dates or probable doubtful dates, right? So that is following the principle of conservatism. But you anticipate that your supplier is going to give you a discount, you will not record it unless and until you get that discount. Okay, this is following the principle of conservatism. Then there is something called as materiality. All the material transactions should be separately, or all the material items should be separately recorded as they should come as a separate line item in your financial statements. Okay, so material items means if there are bad dates, like somebody asked the query, right? If there are bad dates, you cannot club them under miscellaneous expenses, because it will have an influence on the decision of the users. Users should know ki itna revenue kiya, but out of that, the quality of their customers is very bad because 50% is becoming bad. Okay, so whatever is material means significant. If you do not disclose it separately, it could have an impact or it could influence the decision of the users. So materiality could be in respect of amounts that are involved, some high amount transaction, it should be disclosed separately. Okay, it could be in with relation to the nature of transactions, some lease, operating, financial lease, your bad dates, payments made to the directors, managerial remuneration, all that should be separately disclosed. All the financial transactions relating to the business should be disclosed. That is full disclosure. But which are material, which are significant, they should be separately disclosed. They just cannot be clubbed. Okay, you cannot just randomly put them under miscellaneous expenses, right? Then substance over form. Substance over form means the transaction should reflect the true nature of underlying nature of the economic, what is the economic reality of the transaction, that should be reflected in your accounting entry, right? So if an advance is received from the customer, it should not be recorded as sales. That is just an advance received. That is a liability. It should be recorded as that. Or your financial lease cannot be recorded as operating lease or vice versa. So what is the true nature of the transaction? That should be reflected when you are recording it in your books of accounts. That is what the principle of substance over form states. Now, there are 3 accounting assumptions out of the accounting principles that we discussed, accounting principles and conventions: going concern, accrual, and consistency. These are the 3 basic accounting assumptions. Means it is assumed that books of accounts, the business is a going concern, books of accounts are prepared following accrual concept, and the accounting methods or policies are consistently followed. These are the basic assumptions. You don't have to expressly state them in your notes to accounts or anywhere. If any of these are not followed, means if you choose, you are a sole proprietor and you choose to record the transactions on cash basis, then if you're not following accrual, you should say ki, okay, the books of accounts are prepared following the cash system. But if you are recording it using accrual, you do not have to state accrual system is followed, or there is no change in the accounting methods. You do not have to record that. But if there is at any in any year there is a change in any accounting method or accounting policy, then you have to mention. So these are the three basic accounting assumptions. Yes. Now I have some caselets. You can just quickly go through each of them, and you can put the answer in the the chat box. Right. The managing director wishes the company's good industrial relations to be reflected in the accounts. Explain how would you treat each of the following cases, and also when the managing director wishes that the good industrial relations should be reflected in the books of accounts. Is it possible? Yes. Which principle? No. Which principle? Just quickly put it in the chat box. Is not audible? My voice is not audible. Is that the case?
Yes,
Ashna? I'm audible, no? So yes is for audible, no? It is not for not audible.
yes, audible. Ma'am.
Okay. Yeah. Okay. So come on, quickly.
Ma'am, can you just please explain again?
Books of accounts. I can pass an entry for this good relations. Okay. Okay, I'm getting a message. Okay, did you get my question? Did you get my question or no? Okay, the answer is no.
Ma'am, question is repeat again.
Okay, question is, are you able to view this, see this? Okay. Are you able to read this? The managing director wishes the company's good relations should be reflected in the books of accounts. Is it possible? Yes or no? Can you record it in the books of accounts? Put your answer in the chat box. No. Why not? Why not it is possible? According to which accounting principle? Okay, you cannot. Okay, I hope there is no problem with my audio. So I will discuss this. Even though the managing director wishes that the company's good industrial relations should be reflected in the accounts, it is not possible to record it as per your money measurement concept, right? What does money measurement concept states? Whatever can be quantified in terms of money should be recorded. Now, this good relations, you will not be able to quantify it in terms of money, right? Okay, clear this first case, let everyone.
Yes, ma'am.
Yeah, okay. Now, let us look at the second one. Although the sales have not yet actually taken place, some reliable customers of the company have placed several large orders that are likely to be extremely profitable. So how would you treat this? Would you record this? The second case study that I'm looking at, would you record it as a sale or no? Yes or no? We'll record it as a sale?
Yes.
Yes. Okay. Okay. Sales have actually not yet taken place. Okay, but they have just placed large orders. So following the realization concept, if you remember, we discussed when there is a certainty here in this case that the revenue will be realized only when I have honored those orders, right? I have prepared the goods or whatever is required as per those orders, and I have delivered or dispatched those orders to the customers. Then only I will say that sale has taken place. Even though the orders are likely to be extremely profitable, even though the reliable customers have placed several orders, but it is possible. Lockdown is imposed, and however reliable the customers are, however reliable supplier I am for them, okay, I'll not be able to complete those orders, right? So then there is no certainty for realization of revenue in this case. Only when I'm able to dispatch those orders to the customers, I can record it as sales. Okay, so I will not be able to treat it as sales based only on the orders received. I can mention that I have received so much orders, this is my pipeline, but I cannot book it as a revenue. One of the owners of company has invested his drawings in some corporate bonds and shares. Would this be recorded in the company's books as investments? Yes or no? You can put it in the, yes, we have moved on to the third case slate. Owner of the company has withdrawn money for personal use from the company and then he has put it in some bonds and shares. Are these company's investments or are these his personal investments? Okay. Yes, these are his personal investments and these will not be business entity concept. Businessman and business are two separate entities, right? So whatever investments are done by one of the owner of the company at personal level by withdrawing money as drawings for personal use, he has taken out money, right? Cannot be treated as investment of the company. At the year end, an amount is outstanding in respect of electricity bills. So would this outstanding amount, so this is a liability also, but would this be also recorded as electricity expenses? Would this be recorded as an expense? Electricity bill? Yes, it will be recorded as an expense because by accrual concept, expense incurred. Amount is outstanding means what? Electricity का bill आया है मुझे, क्यों आया है? क्योंकि मैंने electricity consume किया है. When I am consuming the electricity, it is an expense. I have not paid the bill, so it is a liability also outstanding. But it is an expense also on one hand, dual aspect concept. It is a liability because I have not paid the bill, but at the same time, since I have consumed the electricity for my business purpose, it is a expense. So yes, it will be recorded as an expense. A debtor who owes a large amount of money is rumored to be going into liquidation. So what do we do here? We put it as a provision for doubtful debt. We are looking at the last of the case study. A debtor who owes a large amount of money is rumored to be going into liquidation. So yes, it will be bad debt or it will be a doubtful debt. It is rumored. It is not yet for sure, but it is possible that he might become insolvent. Yes, it will be recorded as a doubtful debt. We will create a provision out of profit for doubtful debt following our conservatism concept. Provide for all probable losses, but do not provide for probable gains. Right? Okay. Yes. Can we have polling question 2, then followed by polling question 3? First polling question 2. Please answer the polls. Please quickly answer polling question 2 so I can discuss it and then we can move on to polling question 3. Okay, so we will just discuss. So I had just a few minutes back discussed this. Which of the following are the 3 basic accounting assumptions? Means they are assumed. Okay, the users will assume that these are being followed. That is going concern, consistency and accrual. 53% have given the correct answer. So going concern, consistency and accrual are the three basic accounting assumptions. Only in the case that they are not followed, a mention is required. Otherwise, it is assumed that a business is a going concern, the accounting policies and methods are consistently followed, and the transactions are recorded following the accrual concept. Yes, can we have poll question 3? Yes, please answer the question. Answer it fast so that we can discuss it. We discuss it now. Yes. So the accrual basis of accounting. What does accrual concept say? When you should record income and expenses, income earned and expenses incurred are to be matched against one another to understand whether the business has incurred profit or loss, right? So revenues are recorded not when they're collected, not when they're contracted, not when they're readily available for use, but when they are earned. So that is the correct answer. 39% only have got it correct, but I had hoped that you should have got it correct. Okay. Now, coming to the accounting standards, just a quick overview. So what are accounting standards? We already discussed, right? We discussed that accounting standards, they have legal backing, they are formal rules. I also explained to you that in India, the accounting standards are issued by Accounting Standards Board. For companies, the Ministry of Corporate Affairs, in consultation with NACAS, the National Authority on the National Accounting Committee, will mandate what are the accounting standards which need to be followed by the companies, but they are formulated and issued by Accounting Standard Board. What is IFRS? IFRS are International Financial Reporting Standards. They are formulated by International Accounting Standard Board, which is an independent body headquartered in London, right? And we now have Indian accounting standards, Ind AS, which are aligned to IFRS, right? IFRS are the accounting standards which are globally followed. Now, Ind AS are something which we have aligned. We are not using IFRS as they are, but we have made changes in our accounting standards so that most of the, please mute yourselves. Most of the, please mute yourselves. Whatever is relevant in Indian context, we have taken it or converged our standards with the International Financial Reporting Standards. Right now, there are 41 Ind AS that are notified, and now Indian accounting standards which are converged with IFRS, they are mandatory for listed companies, and for unlisted companies, I think there is a limit of net worth of 250 crores or more for unlisted companies to follow the to use this accounting standards which are converged with IFRS. Now let us quickly look at some basic accounting terms. Those who have studied accounting, they must be very well aware. I will just quickly explain it for the benefit of those who are learning accounting for the first time. So what is an asset? What is the liability? What is capital and drawings? What is income and expense? So what is an asset? Asset are the resources that are owned and controlled by the business. Okay. Assets are those resources that are acquired for use in business for a long period of time. Okay. We call them as fixed assets. Under fixed assets, there are tangible assets which have physical presence, machinery, office building, factory building, right? Yeah, these furniture. These are some very, very common examples of tangible fixed assets. We also have intangible assets, which are classified under fixed assets. They are intangible, means they do not have physical presence, but they help you to do business. Just like machinery, office building, computer, laptops, they help you to do business, right? In the same way, intangible assets like patents, copyrights, trademarks, goodwill, they help you to do business on revenues. These are your long-term assets, which are called fixed assets. There is something called as current assets. Now, current assets arise because you are doing business. Fixed assets are acquired so that you should be able to do business. Machinery. Without machinery, you will not be able to produce goods. Laptop. Without laptop, you would not be able to, manage the customer orders or say the accounting part, noting down everything, right? Furniture, table, chairs, your furniture, like the whatever furniture is used in your factory building. Factory building. Without factory building, where will you keep the machinery? So just as fixed assets help you to do business, help you to earn revenue, they are in business for a long period of time. Current assets arise because you are doing business, and current assets will change their form. So for example, you purchase raw material. Now before that raw material is issued to production, right, it will be in the stock. This stock of raw material is your current asset. The moment it is issued in production, there will be work in progress going on. That stock of work in progress is also your current asset. Once the production process is complete and you have finished goods, that is also your current asset. Inventories. You sell the finished goods to a customer for credit, right? So you have receivables in your books of accounts, which is also a current asset. The customer pays money to you. You have cash, which is a current asset. You use the cash again to acquire raw material. So current assets will change form, right? You have cash, then you have stock of raw material, you have stock of work in progress, you have stock of finished goods, you have receivables, again you have cash, right? So current assets arise because you're doing business. Okay. Fixed assets help you to do business. Okay. So assets are resources that are owned and controlled by the business. They are my assets. Receivable is an asset. Why? Because money is receivable against the benefit that you have given to the customer in form of goods or services, right? Stock of raw material is an asset. Why? Because it is going to help me in producing finished goods. Finished goods is an asset because it is going to help me to generate revenues, right? Then what are liabilities? Liabilities are obligations, something which the business owes. Asset is something which the business owns. Machinery is owned by the business. Stock of raw material acquired and owned by the business. Bank loan is a liability, means it owes money to the bank for the loan that it has taken. Okay. In the same way, capital is a liability for the business. Following the business entity concept, businessman has contributed money. Business has to repay it whenever the business closes or whenever the owner demands it back. In that sense, it is a liability. So whatever obligations, whatever business owes is a liability. It purchases goods from supplier on credit, then there is a payable. He has to pay money to the supplier. Outstanding electricity bill. He has consumed electricity, but he has not paid it. Liability. Okay, right? So liabilities are obligations of the business. Whatever business owes to the outsiders. You have long-term liability. You have taken a term loan, okay, and it is repayable within a period of 5 years. It is a long-term liability. You have current liabilities again. So long-term liabilities are source of funds for the business. Like company issues debentures, long term, right? Share capital. It is a perpetual, for the company form of business organization. So it is a source of funds. Preference shares, equity shares, debentures, secured loans, right? And current liabilities, again, they arise because you're doing business. Payables, outstanding expenses. Okay. Short-term loan, 1 year working capital loan. Okay, all these are your short-term liabilities, but still they are obligations. Okay, capital, now from point of view of a sole proprietary concern, a single person doing business, capital is anything that he contributes for his business. He contributes in terms of money, in form of money, in form of asset, a cupboard lying at his place. He starts using it for his business. It is his contribution for the business from his personal belongings, right? So it is a capital. Any goods, that is a capital. What is drawings? Drawings is opposite of capital. Capital is the amount that a businessman invests in the business. It could be in form of money, or it could be in form of asset. Drawings is whatever he withdraws from the business for his personal use. He makes payment of his son's tuition fees from business bank account. It is a drawing. He uses the goods manufactured at his business for personal consumption, drawings. He withdraws money from the bank account, drawings. Okay, so anything what is contributed by the businessman for the business is a capital. Whatever is withdrawn for personal use is a drawings. What is income? Income can be classified as operating income and non-operating income. So whatever is revenue that is generated from sale of goods and services, core business activities, is a operating income. Whatever is the revenue that is generated from non-core business activities or non-operating activities, like whatever is a surplus money lying in my business bank account, I decide to invest it in fixed deposit and I earn interest on it. A part of our office space is vacant and I decide to give it on rent to some other business enterprise. That rent is a non-operating income. Interest received, non-operating. I decide to put business money in shares and I receive dividend, non-operating income. Expense is the cost that is incurred, okay, for the purpose of earning revenue. Administrative expenses, telephone expenses, electricity expenses, office staff salaries. Okay, these are all administrative expenses. Then my direct expenses will be whatever is the cost of goods sold, right? Whatever are the wages paid to the laborers who are manufacturing the goods, right? So that is all these are expenses. Okay, so these are the simple accounting terms that I wanted to explain. Yes, can we have our polling question 4, please? Okay, can you please answer it fast so that we can discuss it, because I have a couple of more slides that I have to discuss before we call it a day. Yeah, are we done? Can we end the poll? Okay, so the question asked was, out of the following, which is the odd one out? A creditor account, outstanding rent, salary account, and advance received from customer. Okay, so creditor is what? Creditor is my liability. Creditor is any person to whom I owe money, right? Debtor is someone who owes me money. Means a customer to whom I have sold goods on credit is my debtor, and creditor is a supplier from whom I have received goods on credit. Means I have received the goods, but I have to pay money to him. So he is my liability. Creditor is a liability account. What is outstanding rent? Outstanding rent means I have taken, say, for example, an office space on rent. Yes, I have used it, say, for this current month, and the rent is due for payment at the end of the month. Now it is end of the month and I have not yet paid the rent. So now that rent has become overdue, right? So it means it is outstanding. Now again, this outstanding rent is something which is payable. Anything which is payable is my liability. So this outstanding rent is also a liability, just as creditor. Advance received from customer. Advance received from customer is again a liability. Why it is a liability? Now customer has given me some order and he has also given me some advance against that order, right? Now, if tomorrow I do not complete the order or tomorrow I do not dispatch the goods, say for example, then whatever advance he has given me is payable back to him. He has a right to receive it back. In that sense, unless and until I complete or honor my side of the contract by delivering him the goods, the advance received from customer is also a liability. Creditor account, outstanding rent account, advance received from customer account, all these three accounts are liability. Salary account is a expense. Yeah, salary and wages account is a expense. So what is the odd one out here? Salary account is the odd one out because all these three are liabilities and salary is a expense. Okay. Can we just close this poll? Now let us move on. Yes. Now what is the accounting process or accounting cycle? I'll quickly take you through that. Okay. So there is something called as source documents, right? Just give me 1 minute. So there is something called as source documents. What are these source documents? These are the invoices, the vouchers, which will evidence that some transaction has taken place for the business. Now, based on these source documents, you will record the transaction first in journal, which is the primary book of record, which is known as the day book also, right? So journal is the first step or first place where you will record the transactions. From the journal, the transactions are posted to respective ledger account. So for every asset, every liability, every income, every expense, there will be a separate ledger account. So there will be a machinery account. So all the transactions relating to machinery will be posted in that machinery ledger. There will be a furniture account. There will be a revenue from sale account. There will be an interest income account. There will be an interest expense account, right? So for every asset, liability, income, expense, there will be a separate account, and from journal, the transactions will be posted in these respective accounts. Now, once all the posting is done, the accounts are balanced, the ledger accounts are balanced, and you will prepare a trial balance of the balances. And based on this trial balance, you will prepare the financial statement. Trial balance is nothing but you will just put the, you can say the debit accounts having debit balances at one place and accounts having credit balances at one place together, right? Okay. Now, quickly, let us look at the types of accounts. So, as I said, any business would have few asset accounts, liability accounts, income accounts, and expense accounts. Now, how will a transaction be recorded? Means what will be debited and what will be credited. Now, it will depend upon, I will give you quickly 2 examples. I think it is already 7:19. So, and we have a couple of slides to discuss. So, I will just quickly run you through this. Okay, this is well explained on Canvas. You can go through the videos, you can watch the videos. Okay. Now, say for example, purchased machinery by paying cash. Now here, what are the 2 accounts that are involved? Machinery and cash. Machinery is also asset account. We saw what is asset. Cash is also an asset account, right? Now what is happening here? Machinery is coming into the business and cash is going out of the business. So how will I pass? What account will I debit and what account will I credit? When there is an increase in asset, I will debit that particular asset account. So here Machinery is coming into the business, so I will debit machinery account. And when there is a decrease in the asset, so when there is an increase in the asset, I will debit that account. So here, whatever example I have given, machinery is coming into the business, so I will debit machinery account. And when there is another account is cash, that is also a asset. There is cash is going out, so there is decrease in that asset, so I will credit cash account. Now similarly, we will take another transaction. Bank loan is repaid. Okay, bank loan is repaid. Right? Now here two accounts are involved. Bank loan is repaid by paying cash or by depositing cash in the bank. Right? To the bank, giving the cash to the bank. Right? So here two accounts involved. Bank loan. Bank loan is of course a liability. Now I'm repaying the bank loan, so there is decrease in the liability. So I will debit bank loan account. And another account is cash. Again, there is decrease in asset cash, so I will credit cash account. Now, had the transaction been other way around, took a loan from bank for rupees 20,000. Here, again, two accounts are bank loan and cash. What is happening? A new liability is arising whenever I'm taking a bank loan, right? So there is an increase in liability. So I will credit bank loan account and I'm getting money. Bank is giving me loan in form of money, right? So there is increase in the asset, so I will debit cash or my bank account. So debit cash or bank account, credit bank loan account, right? So this is how this rule. So I showed it to you for asset liability. For example, I sold goods for cash. Now two accounts involved are, one is income, revenue from sale of goods is one account and cash is another account. Whenever income is on, I will credit that particular income account. So revenue from income, revenue from sale of goods is an income account. Income is on, I will credit it, and cash is coming in, so I will debit it. Whenever expense is incurred, telephone bill paid in cash. Debit that particular expense account, so telephone expenses account will be debited and cash is going out, so I will credit cash account. Okay, so you have to see what are the account involved in a particular transaction. There will be asset, liability, income or expense. And then you have to see what is happening, whether asset is coming in, going out, whether liability is coming in the business or it is being extinguished, whether income is earned or whether expense is incurred. And accordingly, you will have to apply this debit credit rules, right? Now, yes, debit what comes is credit what goes out. That is then the traditional classification, those who have already studied accounts, is personal, nominal and real, and then there are different rules for that, right? So here, as per a contemporary approach, you can just classify the accounts as asset, liability, income, expense, and then follow this standard debit credit rules. So for real accounts, it is debit what comes in, credit what goes out. Personal account, debit the receiver, credit the giver. Nominal account, debit expenses, losses, credit incomes and gains. But those who are learning accounting for the first time, they will find this approach much easier. Okay. Now, again, when we do transaction analysis or when we follow the dual aspect concept, every transaction, okay, will satisfy this basic accounting equation. What is the basic accounting equation? Assets is equal to liabilities plus capital. Now, drawings are opposite of capital. So assets is equal to liabilities plus capital less drawings. Okay. Now, if any profit is incurred, then that profit will belong to the owner. So profit will be added. And if any loss is there, that also the owner has to bear. So if there is any loss, is nothing but negative profit. So loss will be subtracted. Profit will be added to the capital, right? So, and how you will know whether there is a profit or loss? By doing income minus expense. Income minus expense will give you profit or loss. So every transaction will satisfy this basic accounting equation, right? Every transaction will have an effect in such a way that your basic accounting equation will be satisfied. And you can look at this part. Assets is equal to liability plus capital less drawings, add profit less loss, or plus income less expense. So if you see the videos on Canvas, we have done some few examples there. You can go through that, like how each transaction will satisfy this basic accounting equation. Again, this is based on the duality concept or dual aspect concept. Okay, right. Yeah. We will skip, as of now, we will not take polling question 5 because there are 5 minutes to go. Is that okay? I will complete first everything what I want to explain, and then in the end we will take the 2 polling questions 5 and 6. Right. So now account, okay. So this is what I have already explained. Let us look at, yes. Yeah, or I will quickly show you this. This is there in the Canvas recording also. You can see that. So these are a few basic transactions. We will not discuss it now because we have time till 7:30 already. I'll be overshooting the time. But this sheet is there in the Canvas recording also. You can see it there. You can see the recording there. So this is the basic accounting equation. How each of this transaction I have shown will satisfy this basic accounting equation. Then I have shown here, given few examples of how the same transactions you will prepare journal, then ledger, and then, okay, yes, these ledgers are prepared, and you will have trial balance also. So just show you the trial balance and then we will discuss. So this is the trial balance, means after balancing the ledger account. Now how the ledger accounts are balanced, again I've explained it in detail on the resources that are shared on Canvas. Please go through it. Now these are the balances. This is the trial balance, which is said to be the starting point of preparing your financial statements, your profit and loss account and balance sheet, right? So here you will record the balances in each of the account. After balancing the ledger accounts, you will put your balances here. Okay. Now you will see the debit balances are put together: cash account, goods account, furniture, machinery, cost of goods sold, rent. These are having debit balances. So if you have noticed, your assets accounts and your expenses account will always have debit balances. Your liabilities and income accounts will have credit balances. See here, capital, bank loan account. Okay. They will have credit balances, right? Yeah. So this is the trial balance, right? Now let us go to the slide. Now there are certain limitations. Just give me 1 second. I have to just plug in the laptop. Sorry for the interruption. I had some follow-up. This thing. Now, what are the, now this trial balance, as I showed you, okay, that trial balance is the starting point. Okay, so from that trial balance, you will see what is asset, what is liability. Assets and liability accounts will go to your balance sheet. You will see what is income and expense, and those income and expense account will go to your profit and loss account, right? Now, this trial balance is supposed to be this, and once your trial balance tallies, the debit balance is total tallies with the credit balance is total, it will ensure arithmetical accuracy. Means for every debit you have given a corresponding credit, it will ensure that. But there are certain errors which could occur in your accounting process, but which will go undetected even though your trial balance matches. Okay, that is error of principle. When something which has to be recorded as an asset, you record it as an expense. Okay, I purchased machinery, and instead of recording under machinery account, I recorded it as purchases account, right? Then that is the error of principle. So instead of debiting machinery account, I debit purchases account. There is a debit. Okay, instead of debit to machinery, there is debit to purchases. So this is the error of principle, right? Still your trial balance will tally because एक जगह debit होना चाहिए था, account गलत किया है, पर debit तो दिया है. So your trial balance will match. Okay, but there is an error because something which has to be recorded as asset, you are recording it as a expense. There could be errors of omission, partial omission. Means I say for example, I purchased goods by paying cash, right? I recorded I recorded the entry in cash account, but I did not record it in purchases account, or vice versa. Okay, or I purchased goods for credit. I recorded the entry in purchases account, but I did not record it in the suppliers account. Okay, so this is a partial omission. Your trial balance will not match, but complete omission is there. I did not record a particular transaction at all. So one debit is not there, one credit is not there. Still, your trial balance will match. So that is the error of omission. Errors of commission means, again, instead of recording it, say I purchased goods from Ram on credit, and instead of Ram's account, crediting Ram's account, I credited Sham's account, or I credited Ram's account for a wrong amount, or I entered the transaction for entirely wrong amount. Okay, still my trial balance would match because debit bhi wrong amount ka hai or credit bhi wrong amount ka hai. Then there are certain errors which are called compensating errors, right? Means they will cancel, the one error will nullify or cancel the other error. Okay, so for example, if I record purchases instead of 1,200, I record it as 2,100. So debit to purchases account is 2,100. Okay, I record one transaction as that. And similarly, one sales also I record, instead of 1,200, I record 2,100. So credit to sales account is also 2,100. So these two errors will nullify each other, because for one wrong debit, there is a equal wrong credit of same amount. Okay, so these are certain limitations of trial balance. Okay. Now let us look at what are the financial statements that are prepared for proprietary concern. So you have, for proprietary concern, many a times a separate trading account is prepared. Nowadays, only profit and loss account is also prepared, right? So profit and loss account, it is called as a period statement. Why? Because it is prepared for a period of time, for a period of 1 year, right? And it shows the financial performance or the profit or loss for that 1 year, the result of the financial transactions for 1 year. Okay, therefore it is called as period statement. And then you have something called as balance sheet, which is a point statement which shows your financial position, your assets and liabilities as on a particular date. So balance sheet is usually prepared at the last day of the financial year, right? So as on 31st March, it will show you financial position, which will change. Maybe on 1st April, your assets and liabilities could be different if you sell some assets, or if some assets get converted, current assets, they change their form quickly, right? Yeah. So now here, let us quickly see the format of trading and profit and loss account. Are you able to see this, all of you?
Yes.
Yeah. So in trading account, the debit side, again, trading and profit and loss account. So again, it is a account. You have a debit side and credit side to it. Okay. So in trading account, debit side, direct expenses and opening stock is recorded. And on credit side, your closing stock and sales and any outward movement of goods other than on account of sales are recorded. Okay. Now, if your debit side is greater than your credit side, the debit side total is greater than your credit side total, when you balance the account, you record it as a gross loss. What is mean by balancing? Balancing means making two sides of the account equal, right? So if debit side total comes to 10,000 and your credit side total comes to only 8,000, then 2,000 is your loss. And that is how you are recording the balance of your trading account, so that you are making two sides equal. When your credit side is greater, because incomes, outward movement of goods is recorded on the credit side. Okay. If credit side is greater than your debit side, then you have gross profits. If credit side total comes to say 20,000 and your debit side total comes to 10,000, then you have a profit of 10,000. Okay, right? Now here, actually, how you are recording your closing stock here. Okay, but actually, what is the equation that you are using? Opening stock, add purchases, less closing stock, because you are recording it on the opposite side, will give you the cost of goods sold. That is expense, plus the wages and other direct expenses. Direct expenses are the expenses that are directly related to purchase or production. So carriage inward, wages, power and fuel, factory expenses, whatever our expenses are incurred relating to manufacturing or relating to purchase are recorded here, right? And sales, that is your revenue, less returns, if any returns are there, so net sales, and any other outward movement of goods. Okay, because of which that, so you have purchased them, but they are not in your closing stock, neither are they sold, but they're lost in accident, fire, theft, they are distributed as free samples, they are withdrawn for personal use. So all these outward movement of goods are recorded. So opening stock, add purchases, less closing stock, less any other outward movement of goods, add other direct expenses, will give you the expense part. Then when you subtract it from sales, if your sales are greater than all this, there will be a gross profit, or else there will be a gross loss. Then all the indirect expenses, usually your administrative expenses, they will be recorded here. Selling and distribution expenses and administrative expenses, they will be recorded in the second part of your, which is called as profit and loss account. So this part, okay, where you found out gross profit or gross loss, that is your trading account, and this part is your profit and loss account. Again, expenses will be recorded here, indirect expenses, and any other income other than your, so any non-operating income will be recorded here. Discount received, commission received, rent received, interest received. So again, if your debit side total, which represents indirect expenses, is greater, then you will record the balance as net loss. If your gross profit plus your other income is greater, then you will record it as net profit. Where will this net profit or net loss go? It will go into the balance sheet here in capital account. So capital account opening balance, if there is a profit, it will enhance the capital balance. If it is loss, then it will reduce the capital balance. Less drawings. So you have liability side where you will show liabilities as capital, long term, and current liabilities, which we have already discussed. And on asset side, you have fixed assets, investments, and current assets. So finally, your asset and liability side total, your balance sheet total should match. Okay, so this is what we discussed. So trading and profit and loss account, as I explained, it is a period statement. Why? Because it is prepared for an entire whole year. It shows the results of the entire year. Gross profit or gross loss, sales minus your cost of goods sold plus other direct expenses. Profit or loss account, your gross profit plus any indirect income. If there is a gross loss, then it will get added to the indirect expense. Right? Adjusting entries are nothing but your entries for outstanding and prepaid or depreciation, because depreciation is a non-cash expense. So whenever the like, or I will take example of say anything which is outstanding. So if rent is outstanding, means I will record rent as an expense, and it is payable, so that will come as a liability. So that becomes my adjusting entries, because it will not come through cash and bank account because I have not paid it. Similarly, if any insurance has been paid in advance, means prepaid, it is paid for, say for example, next year also, then it has come through my cash and bank account, but it is now lying in my expense for the current year. Anything what I have paid in advance for the next year is not my expense for the current year, right? It is a asset because I have paid it in advance and I have yet to receive the benefit for the payment that I have made. So then to take it out of my expense and show it as an asset, I need to pass certain adjusting entries, right? Now, so this is what I already discussed. Balance sheet is a point statement. It helps in understanding total assets. What is the equity, owner's equity or capital, and liabilities. Yeah, and we have polling question 6. Okay, these are the takeaways. So can we have polling question 5 and 6 right now, just before we call it a day? Yes. Okay, can you please answer it fast? We have one more question to go. Yes, can we share the results and end the poll for this so I can discuss? Yes. So I will discuss the answer. I'm not seeing here the entire answer. Okay. So I will just discuss what is the right answer. Purchase of machinery worth rupees 10 lakhs, partly by making payment in cash of 2 lakhs and balance by way of loan. This transaction would have a impact of, now what is the impact of this transaction? Machinery is coming in worth rupees 10 lakhs, one asset is coming in worth rupees 10 lakhs, cash is going out worth rupees 2 lakhs, cash is also another asset, right? So the net effect on asset is how much? 10 lakhs coming in, 2 lakhs going out, so 8 lakhs. Net increase in asset is 8 lakhs plus 10 lakhs minus 2 lakhs, and 8 lakhs is a loan, because 10 lakhs ka machinery, how it is financed, 2 lakhs by paying cash and 8 lakhs by way of loan. So the impact is increase in asset side by 8 lakhs and increase in my liability side also by 8 lakhs. This is the correct answer for that. Can we have poll question 6? Yeah, a very easy question. What is a balance sheet? Whether it is a period statement, point statement, reconciliation statement. Yes. Okay. Can we stop the poll? I'll discuss the result, or I'll discuss the answer. Yes. So a balance sheet, we just now discussed, it is a point statement. It shows the financial position at a particular point. As on, balance sheet is always as on. Profit and loss account is always written as for the period ended or for the year ended, right? So balance sheet is a point statement. It is not a reconciliation statement, neither it is a period statement. And it is a record of assets and liabilities, but income and expense are recorded in profit and loss, and the net result of income and expense, it is transferred to the capital account. So yeah, so I think I just overshot today, that is 7:43, but these were the takeaways. And you can also watch the Canvas videos on the Canvas, recordings on the Canvas. Yeah, I think I'm done with the session now.
Excuse me, ma'am.
Yes.
Thank you, ma'am.
Yeah.
Ma'am, when will be our examination of first semester?
See, these all questions you can reach out to the administrative team. Okay, like they will be able to guide you.
Hello, Madam Rohini here. So I do have one question. In, I think, last third slide, we do have that equation. Asset is equal to liability minus something income, right?
Yeah.
So I just got a little bit confused. How asset is equal to liability, even though those two are
Yes. Now, but what is balance sheet? Balance sheet is the same thing, no? What do we show in balance sheet? Assets on one side, capital and liabilities on other side, right? And in capital, we make adjustments for profit, loss, and drawings. Profit or loss is the outcome of income and expense, no?
Right.
Got it? So this is nothing but a balance sheet which I have put it in a statement form.
Okay, got it.
Got it? Yeah.
Thank you.
Yeah. I'm done. Ashna or Shilpi ma'am.
Yes, ma'am.
Thank you so much, madam. It was very nice and explanatory session.
Thank you, ma'am.
Okay, thank you. Thank
Students,
you.
there are some students, kindly wait. There are some survey polls regarding the session. I just request everyone to kindly give their feedback regarding the session. Shilpi ma'am, can we have a survey polls, please? Yeah, thank you.
Yes, I'm sure.
Students, kindly give your feedback. Ma'am, next question, please. Okay, ma'am. I guess we can end the poll now. So thank you so much, Mansi ma'am, for this wonderful session. And thank you so much, students. So we'll see you in next session now. Thank
Yeah.
you so much.
Thank you. Thank
Yes,
you.
ma'am.
Thank you, ma'am.
Thank you,
Thank
ma'am.
you.
You.
Thank you.
Yeah. Thank
Thank you, ma'am.
Thank you, ma'am.
you.
Thank
Thank
you,
you,
ma'am.
ma'am.
Thank you, ma'am.
You.